This is Countdown to the Open. I'm Lisa Rollins in for Jonathan Farrow. Moments away from the start of trading, if anyone's actually trading, because right now things are pretty much stasis, perhaps stasis to the downside. The Nasdaq down about 0.5%. You've got the S&P lower by about 0.1%. It's been a bit of a reversal, but let's not make anything serious about this because it is a quiet day. If you want to take a look at the yield space, perhaps this is the story behind the Nasdaq. You are seeing yields marginally higher, 3.73% on that 10-year after an incredible retracement, a rethink of how high yields could go over the past couple of days. Crude's higher, $78.34 on the NYMEX, and the euro dollar pretty much range bound, but you are seeing a bit of dollar weakness, dollar strength, a bit of euro weakness, 103.63. It is one of the busiest days of the year for retailers. Companies bracing for Black Friday in the face of higher inflation and souring consumer sentiment. This coming as thousands of Amazon workers prepare to take part in protests and walkouts across 40 countries. One of the campaign's organizers saying, quote, "It's time for the tech giant to cease their awful, unsafe practices, immediately respect the law, and negotiate with the workers who want to make their jobs better." For more, Bloomberg's Ed Ludlow joining us from LA. What's the latest, Ed?
Yeah, good morning, Lisa. I hope you had a good Thanksgiving. Interesting about Amazon is how widespread the action is. 40 countries are expected to see Amazon workers strike or protest. This is a globally coordinated initiative between a number of unions, interestingly led by unions out of Europe. Such a big story for Amazon in 2022, especially here in the United States, the traction that the union movement has had amongst its workforce at a time where some of the third-party data tells us that this Black Friday in particular could be a little softer for Amazon in this key holiday shopping season. One reason being that they held an earlier Prime event in October, which brought some pull forward in consumer spending. The other really big tech story we're watching is Twitter. According to sources in Brussels, Lisa, the remaining staff, just a handful of them, are now gone from that office. But this is critically important because, of course, Twitter faces regulatory questions around the world, but in the European Union in particular, when Musk closed his deal to buy the social media platform on October 28th, it was members of the European Union's leadership who were most vocal about saying that Musk and Twitter had to, quote, fly by the EU's rules. So, you know, it's interesting, they do not currently have staff there dealing with these policy issues. And I think Musk tweeted just overnight that they are going to go ahead with the verification launch next week. And he gave some explanation as to how they'll do that. But a lot of content moderation questions right now for Twitter.
Ed Ludlow, thank you so much. Luke Kawa of UBS has been betting on cyclicals. We caught up with him earlier this morning. Take a listen.
Where we do see kind of room for more progress in the environment is value cyclicals relative to defensives in particular, relative to kind of more high growth tech stocks, and see a lot of scope for continued gains there. And this is just when you're kind of pricing in the degree of pessimism you see now for 2023, then anything that's better than that looks like a very good news story on the cyclical front.
Back with us, I'm so pleased to say, Aberdeen's Luke Hickmore, and also joining us, Allspring's Anne Miletti. And we were speaking earlier with Luke, and I want to get to him on this in a second, about how some of these margin compression issues are going to become more acute heading into next year, especially in the retail sector, as we just heard, places even like Amazon dealing with worker pushback in the face of inflationary pressures for them as well. How is that affecting your view of the consumer discretionaries, the cyclicals that a lot of people are saying could look good?
I do think our investment teams are a little bit more positive, I would say, on the cyclical areas, but not so much the e-commerce, consumer discretionary areas. And I think it's because of the extreme growth we saw. If you look at Q4 2020, for example, the growth that we saw in e-commerce in that quarter was the equivalent of the growth that we saw over the past 17 prior quarters. So 450 basis points of growth in one quarter. And that was obviously a big pull through, obviously COVID related, but now it's just normalizing. And, if we're headed into a recession, will we see more compression instead of just normalization? That's kind of a reason why we're seeing some of the the challenges at the online retailers, I think.
Luke, do you see a distinction between online and in-store? Do you see some sort of differentiation, or do you think that this is going to be a wholesale reset when it comes to earnings per share based on some of these conflicting issues of inflation plus workers demanding higher wages?
So 2020, 2021 were massive years for online sales growth, and I think it brought forward growth of online shopping by 5-10 years in terms of its penetration of total retail spend. So yes, to a degree, but they're going to face exactly the same problems as the bricks and mortar retailers, getting those margins right, keeping their costs down, kind of driving forward rather than being held back by wages. I think that's no different now for online to as it is for bricks. So to some degree, yeah, they can have a good Black Friday. They'll have people hunting down deals like they were everywhere else, but I also think the whole retail industry's got used to what the online does and how you respond to that sort of bricks and mortar side of things. So I don't know. Some of me feels it's a 2021 question.
Interesting. Basically, at this point, Amazon's like any other retailer, just has the cloud computing system that's going to also support it. Luke, from your perspective, if you are going to see this earnings per share, this EPS compression heading into next year, which asset class, which region of the equity market do you think has least priced that in?
I still think you've got to be chasing income equity. Maybe that's because I'm a bond guy, a credit investor, and that's really what I'm all about. But I think if you can get decent quality balance sheet, protectable margins, good track record on dividends and keeping them high, that's the kind of way you survive these kind of equity moves and tougher and tougher EPS projections as we go through 2023. So probably value for me over growth.
And from your perspective, how much are you looking at bond substitutes or things that can generate income at a time when yield is once again a thing?
I do think income is going to play a role here, both in the fixed income market, but also in the equity market as well. We are seeing investors who are looking for more equities where you can find, dividends as well. But I wouldn't discount equities totally. We are seeing broad-based multiple compression that happened. We do need to see more earnings be taken down, right? We have not seen that. We just started to see it this quarter. We need to see more earnings just get more into check here. But if you're an investor and not a trader, there are a lot of opportunities in the marketplace. What we're expecting, though, is for fundamentals really to matter going forward. It's going to be a recovery that companies are going to have to earn. You're not going to get the V-shaped recovery that some may be expecting from policy or the Fed. It's going to be ones that are going to be organic, that companies are going to need to see some growth, whether it's, a value company seeing very modest growth or a growth company generating some top-line growth. But they're going to need to earn that growth, and it's not going to be given to them.
Meanwhile, I do wonder, Luke, from your perspective, you believe that the Fed is going to start cutting rates next year. And from the credit's perspective, do you think that that's going to be a complete boon? That basically we're seeing the recession right now, the Fed's going to pivot really early and then cut rates, and then all of a sudden you get credit outperforming and having the best year of decades.
Possibly. I think it depends which credit market. I like EU, I like GBP. US feels for me that it's got a little bit of lifting to do in terms of where it is and where it should be priced for the problems coming down the road. I mean, as you've been discussing all afternoon, a lot of people thinking we just avoid a US recession. That's not where I am. I think we do get a recession in the US, in which case USIG is not priced yet. But I think there is really good value. And with Anne, I completely agree. Credit, much like equity, there are opportunities all over the place. Dispersion has got massively higher over the last few months. As an active investor, that's just great.
Meanwhile, Michael Hartnett, Bank of America's strategist out there, highlighted that the largest inflow into bonds in the past 15 weeks. That's what we've seen. Long bonds H1. We stay bearish risk assets in H1, set to turn bullish H2 as narrative shifts from inflation and rate shocks of 2022 to recession and credit shocks in H1 of 2023. When you go macro, and Milady, when you take a look at the bigger picture, where do you agree with this and where do you push back?
Well, I do think that we are really, from a macro standpoint, our investment teams do believe that things are going to get a little bit tougher here, that the Fed is pretty serious, but we do also think that they will pause when it comes time to actually seeing that the work they've already done has taken hold. They will pause. But we don't think, again, that they're going to give us those rate cuts immediately. And that's why I said companies are really going to have to earn the right to go up. The stocks will go up, the ones that deserve it, but not all of them. And that does present a lot of opportunity for active managers. And so I think we're really, really well positioned from that standpoint.
Anne Milady, you'll be sticking with us. Luke Hickmore, thank you so much for being with us and have a wonderful weekend. Back with us with a look at the stocks moving at the opening bell. Here's Ed Ludlow. Ed.
Yeah, taking a look at Apple, interesting that it's now under pressure following the protests in Zhengzhou earlier this week. The principal site of its iPhone 14 and iPhone 14 Pro production now down 2% after a Reuters report overnight that production would be impacted to the tune of 30% in the quarter. Also seeing shares of Activision Blizzard down 3.5%. A report from Politico that there is consideration from the FTC to make an intervention in Microsoft's deal to buy Activision Blizzard that could come as soon as next month, the stock reacting to that. Schlumberger had been higher actually, but now down 0.6%. Generally, we saw energy and oil stocks push higher as Brent and WTI edged higher. And really interesting on this one, Lisa, Manchester United continuing its surge up 11.8%, 12% after comments from Prince Abdulaziz bin Turki Al Faisal to the BBC that the Saudi Arabian government would support any private Saudi bid to buy that company. Of course, we learned this week that Manchester United's owners, the minority stake owners, the Glazers, are considering all financial options for the club, including selling that minority stake.
Ed Ludlow, thank you so much and have a wonderful weekend if I don't speak to you before then. Coming up, a record number of COVID cases clouding China's reopening path.
I think the end game is that China will probably by second half of next year accelerate with regards to growth helped by the reopening. But the path to that could be incredibly bumpy.
That conversation coming up next from New York. This is Bloomberg.
I think the end game is that China will probably by second half of next year accelerate with regards to growth helped by the reopening. But the path to that could be incredibly bumpy. And the real reopening we always thought would occur kind of around Q2. And as you see those cases go up, you could say that, the risk is definitely that it's being pushed further out.
It is certainly a bumpy ride right now over in China, with uncertainty looming over how quickly they can reopen, among another record number of cases reported. This as protests at a top iPhone manufacturing plant threatens to impact production by as much as 30%. Team coverage starting right now. Bloomberg's Deirdre Hipwell in London alongside Ed Ludlow in LA. Deirdre, from your vantage point, how quickly are we seeing the cases accelerate in China? How significant is the COVID issue?
The cases are really rising. I mean, they're at a record high, and this is really unusual for China because this is a country that has restricted personal freedoms and really locked down its citizens. So what they're trying to do now is trying to ease restrictions, but at the same time contain the cases, and it's causing a lot of widespread confusion, which is what we're seeing, with the situation at Foxconn and what's happening in Beijing. It's a really difficult tightrope.
Meanwhile, we are seeing, Ed, the impact on U.S. businesses that do a lot of their manufacturing in China, in particular Apple. What has the guidance been out of Apple trying to gauge out the damage from the uprisings at their Foxconn factory?
Yeah, we're talking about the Zhengzhou facility, right, which is operated by Foxconn, a contract manufacturer. It's important because it accounts for 4 out of every 5 iPhone 14s that are made, particularly the iPhone 14 Pro. We had protests earlier in the week. The official line from Foxconn was that those protests were quickly brought to order and that the facility was operating normally. But you had the Reuters report overnight that this would have an ongoing impact which would reduce production by around 30% in this current period, in this quarter. Beyond that, there are some longer term issues here, right, which the protests came as a consequence of what are very tight COVID zero curbs. You saw authorities in Zhengzhou extend those restrictions to 8 districts in the city. And now you're wondering how the Chinese government in particular balances the control of this virus with the economy. And of course, the big news overnight, the RRR cut. In other words, China's central bank, the PBOC, basically reducing the requirement on lenders in terms of the amount of cash they have to hold in reserve, some form of easing. But the situation is still complicated as it relates to global supply chains, and Apple is a pretty good barometer, right, of the impact this is having on what is a central region when it comes to tech production.
Ed Ludlow, Deirdre Hipwell, both of you, thank you so much. Anne Maletti back with us, and Anne, I really do want to focus on the tech sector and how much of some of the disruptions over in China, both from the production standpoint as well as the demand standpoint, have impacted your forecasts for some of the tech giants. Have you really factored this in or started to reset how much you have to consider it heading into next year for the likes of Apple?
This is something that we've been speaking to our emerging market managers about a lot, and more so not just for the emerging markets, but obviously the impact that it can have across all of the strategies that we manage at Allspring. And the interesting thing when we talk to them, not that China is the U.S. in any way, shape, or form, but if you think about some of the similarities that we had when we were emerging from the lockdowns we had, right, state by state, there were a lot of start and stops, a lot of changes to policy, a lot of confusion. And I think, based on what we're hearing, and again, the information flow from China is not always crystal clear, but what we're hearing are a lot of similarities, a lot of challenges, a lot of confusion. And so I think I would expect to see that. I would expect to see a very bumpy road, a lot of, okay, we're going to do it this way, and now we need to make some adjustments. And so that will present some supply challenges, and it will, potentially impact demand. But demand is challenged in the U.S. because we are seeing the real impact of inflation here, right? So our investment teams are working to balance all of those issues. And in some ways, because there's less demand, we believe coming in 2023, maybe the supply challenges are less problematic than a year ago when we had really, really challenging demand.
So in other words, just to sort of consolidate this down into your view in terms of pro or con buying some of the big tech names, do you see an opportunity here after the sell-off this year, or do you see that there are just too many issues pockmarking the landscape?
It's risk versus reward on every single individual name. And I think that's where you have to really be careful in a market like this, is to generalize too much. Because if you just say technology, if you just say semiconductors, if you just say big tech, you can miss really great opportunities. So for us, it's looking name by name and trying to find unique opportunities that might be getting thrown out because of generalization.
Anne Miletti, thank you so much for being with us. Have a wonderful holiday weekend. Let's right now head back to Ed Ludlow to get some sector price action this morning. Such an active morning, Ed. Parse through it and give us something to talk about.
Well, thin volumes after Thanksgiving, but let's go to IMAP Go on the Bloomberg terminal. And basically energy, kind of one of the most interesting sectors this morning, in large part because of reports that the European Union is seeking to boost the curbs on Russian crude. Higher oil means higher energy stock prices. Otherwise, we're very much focused, of course, on consumer and discretionary as we head into what is essential, a crucial part of the holiday shopping season, not just for names like Amazon, but legacy retailers as well. And you see some of that playing out across the equity sectors this morning. Lisa.
Ed, thank you so much. Indeed, it is quite an active day here as people reset with their tryptophanic trances. Coming up, the market-moving events that you need to be watching. That's next in our trading diary. In the markets, wow, look at that. It's completely flat. 40.2693 on the S&P. This is Bloomberg. Welcome back to the Open, and we're taking a look at markets that are somewhat range-bound. You're seeing the S&P basically flat, the NASDAQ down about 0.6%. Really, the action has come earlier in the week when we saw that real drop in yields. Take a look at 10-year yields. Week to date, you can see that they have been declining, and today we're seeing a bit of a bounce back, but really this has been the trade of the week. We've gotten people saying, go its duration, and so they have. You've seen dollar weakening, and that's been pretty persistent. We've seen that for a while, and you could see that continuing on the margins in terms of people's outlook. And then take a look at the 2-10 spread, this gap between 2-year and 10-year yields. It has contracted to the biggest inversion going back to 1981 this week, and that's underpinning this idea that yes, the Fed will hike, but perhaps growth will slow so quickly that we might be able to avoid a hard landing. Time now for a trading dial where you need to be watching the U.S. stock market closing early today at 1 Eastern. Looking ahead to next week, Fed speak, Williams, Bullard on Monday. On Tuesday, we get Conference Board consumer confidence, U.S. GDP and core PCE coming on Wednesday, plus Fed Chair Jay Powell speaking along with Governors Bowman and Cook. Finally, initial jobless claims on Thursday, and rounding out the week, it is Jobs Day in America on Friday. This was Countdown to the Open. Have a wonderful Thanksgiving weekend. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
We're 30 minutes into the US trading day, the shortened US trading day. It is Friday, November the 25th. It is Black Friday, and here are the top market stories that we're following for you at this hour. As I say, shop till you drop. Black Friday is back, stores are open, tills are ringing. We are going to be live in a moment in one of New York City's busiest shopping districts, Herald Square. COVID concerns growing in China as case numbers reach fresh records. The PBOC cutting the RRR by 25 basis points. We'll be on that story as well. And can a transatlantic trade war be averted? France and Germany meet to discuss Europe's response to President Biden's Buy America Inflation Reduction Act. EU trade ministers warn the time is running out. From London, I'm Guy Johnson. Alex Steele has their well-deserved day off. I understand that she's doing some shopping. There is a rumour that she may watch the football a little bit later on. England versus the USA. It's kind of a big game. But it is Black Friday. Shopping, for the time being, seems to be taking precedence over everything else. The holiday shopping season now officially underway. More than 166 million shoppers are expected to dig into their wallets this weekend, basically pushing through pre-pandemic levels. Bloomberg's Kriti Gupta is live in Herald Square, one of New York City's busiest shopping districts. Is it busy, Kriti?
It was busy. I think, look, there's plenty of holiday cheer in the air. There was a massive line at 5:30 this morning outside of Macy's. Now it seems to kind of wash through. There's certainly a lot of trying on shoes and perfume inside, of plenty of stock that they have to get through. But I would say it's not as busy as Black Fridays I've seen in the past. So there is this dynamic that I've seen where a lot of people are going in, trying on clothes, trying on perfume, but they're not coming out with the merchandise. They're going to go home. They're going to shop online now that they've really tried it out. So it's almost like these department stores are less for shopping and more for the experience.
Okay. Does that mean that this is a pandemic hangover effect, or is this just e-commerce continuing to eat into traditional bricks and mortar?
It's going to be a little bit of both, and I would argue that the pandemic legacy essentially is feeding into the further eating of market share between the e-commerce side over brick and mortar. But remember, there's also this idea not just of clearing inventories, but of returns. That has been the major issue. If you are shopping in person, you are also more likely to return in person. It seems like now there are a lot of companies, I'm not going to say Macy's, but a lot of other stores and a lot of other retailers that are now charging for those returns. The idea that if you're trying to get rid of that excess inventory, you're going to do it through higher markdowns. You're going to do it through those promotional items. How do you make up for that lost profit? Well, you charge for those returns. That has become so easy and such a natural part of the e-commerce shopping experience.
Kriti, the consumer is starting to feel a little bit stressed, but unemployment levels are still relatively low. Consumers still have money in their pockets. Are they looking for bargains? Are they actively now trading down?
They absolutely are. And here, you mentioned, Guy, that this is one of the most active shopping districts in all of New York. Look, we're right by Macy's, but around us are more less wealthy income clientele, for example. There's an H&M nearby. There's an Abercrombie & Fitch nearby. And, of course, Times Square just a few blocks over. Not all of the stores around me serve a higher, wealthier clientele. And if you actually look at the foot traffic, just anecdotally, I don't have the numbers to support this, but Macy's is still getting far, far more foot traffic. And I think that really speaks to the idea of this wealth effect and this divergence that you are starting to see from Macy's, from its peers, relative to the likes of Walmart, the relative likes of Dollar Tree, even H&M, which I would put in that lower income category, more affordable, but perhaps not the designer items, the perfumes that you're going to find in this particular store.
What was it like at 5 a.m.? I can remember, as you say, Black Friday's passed. We've seen people almost beating the doors down. What was it like?
Yeah, I mean, that's what I was actually expecting. I was bracing myself for it. Instead, well, I have to say we actually had musicians here playing Christmas carols. And on top of that, you did start to see a little bit of a lineup. Now, about 5:30, you did start to see it start to form around the block. There was a big line. Then as soon as the Macy's doors opened about 6 a.m., they all kind of flooded through. I mean, remember, this is a 6-story building, so there's plenty of room for shoppers. But I would say it is not the chaos that we've seen in Black Friday's past. In fact, like I said, a lot of people are just looking and then going home and buying online.
Great stuff, Kriti. Thank you very much indeed. Kriti Gupta joining us on the Black Friday story. Let's talk about the US consumer and the health of the US consumer and the impact that it's going to have both on the Fed and markets. Joining me now, Maria Weidmann, State Street Global Markets Senior Multi-Asset Strategist. Maria, the US consumer still seems to be in fairly good health. The US employment picture still looks fairly good. Does that mean the Fed's going to have to go further?
Yes, guys, that's exactly our thesis, is that U.S. consumers still, people have jobs, people actually still have savings, so those are mostly represented in a higher income consumer. People have wealth. A lot of this wealth is potentially in housing market. House prices still very, very high, very elevated, and in U.S. you can fairly easy to extract like home loans. So yes, there is wealth, there are money to spend, and consumer is spending, consumer is willing to spend. Maybe they're trading down a little bit in terms of what they buy, but they still buy a lot. And that means that Fed needs to push.
How hard?
Hard.
5,
No, we still expect the terminal rates to get higher, maybe potentially get above 5%, and definitely not expecting a cut next year, maybe a pause.
Okay, let's talk about what's happening in equity markets, and maybe you can solve some of the head scratches that I've got at the moment. Let's start with the first one. Why are European equity markets outperforming US equity markets if, as you say, the US consumer and the US economy still looks in fairly good shape?
This is a very difficult question, and so the way I'm trying to square that circle is, U.S. stocks dominate. Have a huge chunk of U.S. stock market are technology stocks. They are long duration, and they're the ones that suffers the most from increase in interest rates. So that's actually, to me, is quite a very substantial part of explanation. What is happening in Europe? A lot of the index is cyclical, industrial, and exporters, so they benefit from weaker euro. They also benefit, particularly like in the last week, like months or so, there is kind of this hope that potentially Fed is not going to hike as hard as we expect, and that's helping cyclicals to do better. So Europe obviously on the front foot in that trade, but it's kind of duration expectation about how far central bank Fed has to go.
You mentioned the euro just a moment ago. Let's flip it around and talk about the dollar. The dollar has been coming down. Is a weaker dollar positive for European stocks?
So weaker dollar, I think first and foremost now, as a lot of assets are trading very much together, all the correlation gone to one, so it's very much inflation trade, and inflation, Fed, policy tightening, so weaker dollar was, or stronger dollar was really kind of very strong representation of this trade. So if now as we're seeing dollar weakening, then financial conditions are easing, and kind of all stock markets like it, but particularly European one, given at high beta, it's very cyclical, so Europe does benefit from it more than others.
Which side of the Atlantic do you think benefits most from falling oil prices? Because that's the other thing that we've seen this week. We've seen oil prices continuing to track lower. Now you get a more direct read-through, you could argue, in the United States. There's less tax, and as a result of which it feeds through to the consumer very quickly. But Europe at the moment has an energy crisis. So I'm just wondering which side of the Atlantic we should be looking at to get the biggest beneficiary biggest beneficiary of that.
Yeah, no, that's an interesting question as well. We probably fall on European side, benefiting more, because a big scare in Europe was energy crisis, and slightly warmer October already kind of helped Europe a lot, as those kind of dangers of even higher kind of inflationary pressure building into expectation that may be kind of sidelined a little bit. That doesn't put extra stress on government financing, trying to kind of protect domestic consumers. So I think Europe is probably more direct benefit. I think all the kind of effects you mentioned are maybe a little bit like second order effects, and yes, it's helpful when oil prices are not that high, and it helps everyone, but I think Europe is probably more sensitive.
The holiday season is now upon us. Christmas is coming. The Santa rally has been rallying. Does it continue to rally? Do equities continue to do well into year end, do you think, Maria?
I think it's absolutely critically depend. I mean, when equity started to rally, that was that CPI print that really shaking markets and given us hope that we're seeing the beginning of the end of this hyperinflationary environment, and that really given markets a lot of hope. It has been kind of one number, a very, very critical number, and we always said inflation is very, very paramount. But I think in order to see continuation of this rally, we would love to see another weak inflation print. We would love to see more signs of weakness in labor market, and that would really set center rally on. I'm slightly skeptical that we'll see it, but I mean, jury's still out.
Yep, we'll wait and see. Bells are beginning to ring. Holidays are coming. Maria, thank you very much indeed. Maria Weightman joining us, Senior Multi-Asset Strategist at State Street Global Markets. Okay, coming up, could the EU be heading for a trade war with the United States? We're going to look at how the US Inflation Act, the IRA, is causing tensions across the Atlantic. That conversation next. This is Bloomberg.
EU and US share a strategic partnership, and I would say it's especially important in current geopolitical context when we are dealing with Russia's aggression against Ukraine. So it's important that we are cooperating and we are united, and that's indeed why it's so important that this Inflation Reduction Act is being addressed and it doesn't become another irritant in our relations.
An irritant. The European Commissioner for Trade, Valdis Dombrovskis, speaking a little earlier exclusively to Bloomberg's Maria Tadeo at the EU Trade Ministers meeting in Brussels. Jonas Olaf Scholz is also worried about the fact that this situation could descend into chaos. He's been speaking with his French counterpart a great deal about this. Emmanuel Macron, he's worried, is stoking a new transatlantic trade war as he heads to Washington next week. We've got a meeting between Emmanuel Macron and Joe Biden. Bloomberg's Maria Tadeo joins us now to discuss all of this. Plus, we need to talk about what's happening with the oil cap story as well. Maria, let's start off on transatlantic trade tensions. The Europeans are worried about Joe Biden's Inflation Reduction Act. Walk me through why.
Well, Guy, where to start? Because there's so many issues happening here. In the essence, essentially, and you mentioned the German Chancellor, you mentioned Emmanuel Macron, you also mentioned the head of trade for the European Commission. What they worry, essentially, is that the European Union has been hit by what is a perfect storm. You have an energy crisis, of course, that is pushing up energy costs for companies, for made in Europe. You have the United States coming in strongly with the Inflation Reduction Act, especially when it comes to subsidies for the green industry. And on top of that, don't forget, you have the Chinese with their own industrial policy. If you put all of this together, they worry, and they really do worry, in fact, about this idea that the space for made in Europe, for European Union products, is becoming so small to stay competitive and attractive that we could see a real decline. And we're not just talking about the short term, but the medium and long term in made in Europe. That is a concern, and you heard it there from the head of trade, Mr. Dombrovskis here. I spoke to him. He did not mention the trade war, but he did say, quote, there are serious concerns that will have to be addressed, and all the European Union is asking for is fairness. However, on the flip side, Guy, you know very well the criticism here is that some would argue the European Union is paying for bad decades of bad foreign policy and energy policy. Nobody forced them to depend on Russian gas.
Just talk me through, though, how Europe could respond, how the French maybe would like to see Europe responding.
Look, I think that's a very good point. And Guy, if I had to give you an answer, I don't think I could give you one, because there's a lot of noise, but there isn't really a roadmap. The French, Emmanuel Macron, in a very French way, of course, was saying we make great products that the world wants to buy. I'm sure he's thinking of French luxury. Let's really say, let's buy Europe. Let's buy European. Let's make it clear to our European citizens that we have a great product, and maybe you should buy that. Why are you buying perhaps a product that is not made in Europe? On the flip side, you have the Germans who say we do not want a replay of the situation with the Trump administration where there were tariffs going both ways. And I asked flat out to the head of the trade portfolio now, Mr. Dombrovskis, are we going to see a trade war? And he did not even mention the war, trade war, or tariffs. He did not want to go there. I asked him 3 times. He said we have concerns, and we hope they will get clear. What I do want to say, and I just want to point this, is the French and the Germans do agree there needs to be a level playing field. And they had a meeting yesterday in Paris behind closed doors, both the finance minister from Germany and the French.
Maria, let's turn to what is going to happen a little bit later on. I understand we're going to have another meeting to try and resolve the issue of the Russian oil cap. Talk me through where we are and where we could see progress.
Well, Guy, I have the impression I've been here for almost 48 hours, and we talk about the cap, and yet we see no cap, and this thing gets delayed and postponed. Now, we know that yesterday, of course, there was no agreement on the gas cap. That's been delayed to December 13th, but the conversation about the Russian oil cap, it should make a difference. There's 2 different caps that are being debated. There is going to be a conversation with European ambassadors to finally nail the price. Remember, the range is $65 a barrel to 70. Some countries suggest that it's 65. That is not good enough. It should be dropped. But I do hear that there is increasing pressure on both the Polish and the Baltics to agree to that $65 a barrel mark.
Maria, we will watch with interest. Thank you very much indeed. Bloomberg's Maria Tadeo joining us in Brussels. Still ahead, 2 of the biggest companies in the United States, Amazon and Apple, are struggling with labor issues. We'll talk about both of them next. This is Bloomberg. So the Binance CEO, CZ Zhao, spoke to Bloomberg TV in an exclusive interview on what the FTX collapse could mean for the broader crypto universe. He spoke to Bloomberg's Haslinder Ahmed.